Neville died with 1.2 million in assets and a mortgage he had never paid off. His son David thought that was strange. His father had been a careful man, a deliberate man, a man who read the financial pages on Saturday morning and kept a notebook where he tracked every investment he had ever made going back to 1987. Neville was an electrician from Newcastle who had built a small property portfolio over 30 years. Nothing flashy. 2 investment properties plus the family home. Modest rentals in working-class suburbs that he bought when nobody else wanted them and held when everyone told him to sell. When Neville died, David sat down with the estate lawyer expecting to hear about the assets, the properties, the super. The share portfolio Neville had quietly assembled in the last decade of his life. What David heard instead was this. His father had restructured his finances 18 months before he died. On the advice of a specialist tax accountant, not the general accountant who had done Neville's tax returns for 20 years, a different one, a specific one, someone who knew a strategy that most accountants either don't know exists or don't bother explaining because it requires work to implement. Neville had done something that looked, on the surface, completely counterintuitive. He had deliberately kept debt on his investment properties instead of paying it off. He had moved money in a specific direction between specific accounts in a specific order. And in doing so, he had legally reduced the tax bill his estate owed the Australian government by somewhere in the region of $310,000. David stared at the lawyer. The lawyer said, "Your father was a smart man." David said, "Why didn't anyone tell me this was possible?" The lawyer said, "Most people find out too late. My name is Mitchell Levi, and what I am about to explain is real, legal, documented in Australian tax law, and used every single year by a small number of Australians who happen to know the right accountant or the right advisor. The rest, the majority, find out about it the way David did, after the funeral. If you own an investment property, if you have superannuation above $200,000, if you have a mortgage on your family home alongside investment debt, if you are over 50 and starting to think seriously about what your estate looks like, this strategy applies to you directly. It is not a loophole. It is not aggressive tax planning. It is not the kind of thing the ATO is about to close down. It is written into the architecture of the Australian tax system, and it has been sitting there for decades. The reason most people don't use it is not because it is complicated. It is because the conversation that leads to it only happens when you are sitting across from someone who thinks about tax structuring as a whole-of-life picture rather than a 12-month lodgement exercise. Most accountants do the 12-month version. Nothing wrong with them. They keep you compliant. They get your return lodged. They find the deductions available in the current year. What they almost never do, what Neville's regular accountant never did for 20 years, is sit down and ask the question that changes everything. What does the tax bill look like on the day you die? And what can we do about it right now while there is still time to do something about it? Stay with me because at the 9-minute mark, I am going to show you the exact numbers Neville's accountant ran. And the difference between a family that had this conversation and a family that didn't is not marginal. It is 300,000. Before we get started, please like this video and subscribe to our channel to ensure you never miss an update. To understand the strategy, you need to understand 3 things about how Australian tax works at death. 3 things that your regular accountant knows but has probably never explained to you in the context of your specific situation. Thing 1, capital gains tax does not disappear when you die. This is the first misconception that costs Australian families enormous amounts of money. In the United States, there is something called a step-up in basis. When you die, the cost base of your assets resets to market value. The embedded capital gain, the profit that built up over decades of holding, is forgiven by the tax system. Gone. Your heirs inherit at current value with no tax on the growth. Australia does not have this. In Australia, when you die and your assets pass to your beneficiaries, the capital gain that has been accumulating inside those assets since the day you bought them follows the asset into the estate. It does not disappear. It waits. And when the beneficiary eventually sells, or in some cases even when they inherit, the tax bill arrives. For Neville's 2 investment properties bought in the early 1990s for a combined $180,000 and now worth a combined $1.4 million, the embedded capital gain sitting inside those properties at the time of his death was approximately $1.22 million. After the 50% CGT discount for assets held more than 12 months, the taxable gain was approximately $610,000. On $610,000 of taxable capital gain flowing into his estate and then to his beneficiaries, the tax exposure was significant. Depending on the marginal rate of the beneficiaries receiving those assets, David and his sister both had reasonable incomes. The CGT liability on the inherited properties was approaching $200,000 to $250,000. This is not a tax on wealthy people. This is a tax on anyone who bought property in Australia before 2005 and held it, which is millions of Australians. Thing 2, debt against investment assets is tax deductible. Debt against your family home is not. You already know this in principle. Investment loan interest is deductible. Home loan interest is not. What most people have never been shown is what that principle looks like when you arrange your debt strategically across a lifetime, and particularly in the final years of that lifetime. The interest on money borrowed to purchase or improve an income-producing asset is deductible under Section 8(1) of the Income Tax Assessment Act 1997. That deductibility reduces your taxable income every year the debt is outstanding. Here is the key insight that most accountants stop short of explaining. Keeping investment debt, rather than paying it off, is not irresponsible if the asset is appreciating and the deduction is working in your favor. For the right person, in the right structure, with the right assets, deliberately maintaining investment debt while simultaneously paying down non-deductible personal debt is not just acceptable. It is one of the most powerful wealth preservation moves in the Australian tax system. Thing 3, superannuation death benefits are not always tax-free. This is the one that surprises people most. Most Australians assume that super passes to their spouse or children tax-free when they die. This is partially true. Super paid to a spouse or financially dependent child is tax-free, but super paid to an adult independent child, which describes the majority of beneficiaries for Australians dying in their 60s, 70s and 80s, is taxed. The tax on a taxable component super death benefit paid to a non-dependent adult beneficiary is 15% plus the Medicare levy, effectively 17% on the taxable component of the balance. For a super balance of $600,000 with a fully taxable component, that is a tax bill of approximately $102,000 landing on your adult children the year you die. On money you already paid contributions tax on when it went in, taxed once going in, taxed again going out. Most Australians do not know this is coming. Most accountants mention it once in passing during a super review and then move on. The families who avoid it are the ones who took the time to understand the structure and rearrange it before the death benefit was paid. Let me introduce you to Sandra. Sandra is 61. She lives in a suburb of Brisbane. She has a family home with a remaining mortgage of $95,000. She has one investment property with a mortgage of $180,000 and a current value of $680,000. She bought it in 2004 for $210,000. She has $480,000 in superannuation accumulated over a career in nursing. She has no financial advisor. She has an accountant she has used since 2009 who does a thorough job of her annual return and finds every legitimate deduction available in any given year. Sandra has never had the death tax conversation with her accountant. Not because her accountant doesn't care, because her accountant runs a practice with 340 clients, and unless Sandra specifically asks the question, the annual return lodgement process does not naturally surface a 45-minute discussion about estate-level tax restructuring. So Sandra is on track to die in 20 or 25 years, all going well, with approximately the following tax exposure sitting in her estate. Capital gain on the investment property, purchased at $210,000, likely worth $1.8 to $2.2 million by the time she dies if Brisbane property continues its historical trajectory. Embedded gain of approximately $1.6 to $2 million. After CGT discount, taxable gain of $800,000 to $1 million. Tax on that gain for her adult children, somewhere between $180,000 and $280,000 depending on their marginal rates in the year of inheritance. Super death benefit tax on her $480,000 balance, which by retirement at 67 may be $700,000 or more, paid to her adult son who works as an engineer. Approximately $119,000 in death benefit tax on the taxable component. Total tax exposure sitting invisibly inside Sandra's current financial structure, potentially $300,000 to $400,000. Sandra does not know this number exists. Her accountant has never calculated it for her. And there are 3 specific moves, legal, documented, available right now, that could reduce that number to near zero. Move 1. The debt recycling strategy, turn dead money into a tax engine. Debt recycling is not a new concept. It has existed in Australian financial planning for decades, but it is executed by a tiny fraction of the people who would benefit from it because it requires coordinated thinking between your mortgage, your investments, and your tax return. And most people never have all 3 in the same conversation at the same time. Here is how it works. Sandra has a $95,000 non-deductible mortgage on her family home. That $95,000 in debt costs her money every year in interest with zero tax benefit. It is dead debt. The government gives her nothing for it. She also has $180,000 in deductible debt on her investment property. That debt is working for her. Every dollar of interest reduces her taxable income. Debt recycling in its simplest form means using available cash flow or savings to pay down the non-deductible home loan and then immediately redrawing the same amount against the investment property loan or a new investment line of credit and using that redrawn amount to purchase income-producing assets. The key: the redrawn funds must go directly into income-producing investments, shares, a managed fund, additional investment property equity. The purpose of the borrowed funds determines the deductibility. If the purpose is investment, the interest is deductible. If it is mixed with personal use in any way, the deductibility is compromised. Done correctly over 5 to 10 years, Sandra converts $95,000 of non-deductible debt into $95,000 of deductible debt, while simultaneously building an investment portfolio funded by what was previously dead mortgage interest. The death level impact: when Sandra dies, the investment portfolio built through the recycled debt has a cost base equal to what she paid for it, recently at high prices. The embedded capital gain is minimal compared to the investment property she bought in 2004. The tax drag on her estate from these newer assets is a fraction of what it would be on the 2004 property held to death. The debt recycling strategy does not just save tax annually. Over a lifetime, it reshapes which assets are in the estate and what the CGT exposure inside those assets looks like at death. The 2026 position, the ATO has been watching debt recycling arrangements carefully. The critical requirement is that the investment purpose must be genuine, documented, and maintained. Schemes that use debt recycling to fund lifestyle expenses or that mix personal and investment use are being scrutinized. The clean version, pay down home loan, redraw for genuine investment, maintain clear documentation of the investment purpose of each dollar, remains fully defensible and has been confirmed as legitimate by ATO guidance. Move 2, the super recontribution strategy, remove the death tax from your superannuation. Remember the super death benefit tax, 17% on the taxable component paid to adult non-dependent beneficiaries. The recontribution strategy is the legal mechanism for converting the taxable component of your superannuation balance into a tax-free component, reducing or eliminating the death benefit tax your adult children will pay. Here is the mechanism. Super has two components, the taxable component, which is made up of employer contributions, salary sacrifice contributions, and the earnings on them, all of which attract the 17% death benefit tax when paid to a non-dependent adult. And the tax-free component, which is made up of after-tax personal contributions, money you put in from your already taxed salary or savings, which passes to any beneficiary completely tax-free. The recontribution strategy involves, step 1, withdrawing a lump sum from your superannuation, tax-free if you are over 60 under current rules. Step 2, recontributing that same amount back into super as a non-concessional contribution, an after-tax contribution that creates a tax-free component. Each dollar you withdraw from the taxable component and recontribute as a non-concessional contribution converts taxable into tax-free. The death benefit tax exposure shrinks with every cycle. Real numbers for Sandra, her $480,000 super balance is largely taxable component, employer contributions over a nursing career, salary sacrifice, fund earnings. If she does nothing, her adult son pays 17% on approximately $480,000 at death. That is $81,600 in death benefit tax. If Sandra, between age 60 and 75, executes the recontribution strategy, withdrawing and recontributing in cycles while staying within the non-concessional contribution cap, she can progressively convert the entire taxable component to tax-free. Her son's death benefit tax bill moves from $81,600 towards zero. The 2026 constraints you must know, the non-concessional contribution cap is currently $110,000 per year. The bring forward rule allows you to contribute up to $330,000 in a single year by bringing forward 3 years of caps, but only if your total super balance is below $1.68 million. If your balance is above $1.9 million, non-concessional contributions are not available at all. The window for this strategy is age 60 to 75. Before 60, the withdrawal triggers tax. After 75, the contribution rules become significantly more restrictive. The sweet spot is the 15-year window between those ages, and most people spend that window not knowing this conversation was available to them. Move 3. The testamentary trust, the structure that changes what your estate pays forever. This is the move that Neville's accountant set up 18 months before he died, and it is the one that produced the largest single tax saving of the three. A testamentary trust is a trust that is established by your will and comes into existence at the moment of your death. Unlike a family trust that you set up during your lifetime, a testamentary trust is created specifically to receive and manage estate assets for your beneficiaries. Why does it matter for tax? Because income distributed from a testamentary trust to minor beneficiaries, grandchildren for example, is taxed at adult marginal rates rather than at the punitive minors tax rates that normally apply to investment income earned by children. And because the trustee of a testamentary trust has discretion over how to distribute income among beneficiaries in any given year, meaning that income from estate assets can be distributed to the beneficiaries in the lowest tax bracket rather than being lumped into the highest earner's return. For Neville's estate, his 2 investment properties, once inherited through the testamentary trust, generated rental income. That rental income, distributed strategically across David, his sister, David's wife, his sister's husband, and 4 grandchildren, all of whom became beneficiaries of the trust, produced a total tax bill on the rental income that was a fraction of what it would have been if the properties had simply transferred directly to David and his sister and been added to their already substantial personal incomes. Over a projected 10-year period of the trust holding those properties before the beneficiaries chose to sell, the tax saving on rental income distribution alone was modeled at $160,000 to $200,000. The CGT management inside the trust trust, timing sales to years when beneficiary incomes were lower, distributing the capital gain across multiple beneficiaries, produced an additional saving of $80,000 to $110,000. Combined with the debt recycling and recontribution strategies, the total saving across the estate approached $310,000. The 2026 update. The government has flagged ongoing scrutiny of testamentary trust arrangements where the minor beneficiary income splitting provisions are used aggressively. The legitimate version, a genuine testamentary trust with real beneficiaries receiving real distributions for genuine purposes, remains fully supported. The ATO's concern is with arrangements that exist purely on paper with no real distribution occurring. Document everything. Use a solicitor who specializes in estate planning. The structure is legal and powerful when implemented correctly. Here is the question I want you to sit with for a moment. If these three strategies are legal, documented, and have been available in the Australian tax system for decades, why doesn't every accountant explain them to every client over 50? The honest answer is not sinister, it is structural. General practice accountants are compliance professionals. Their job, the job they are trained for, the job they are paid for, the job that fills their calendar from July to October every year is accurate lodgement of your current year return. Find the deductions, calculate the liability, submit the paperwork. Move to the next client. Estate-level tax planning is a different discipline. It requires understanding your superstructure, your property portfolio, your mortgage position, your family situation, your likely lifespan, and your beneficiaries' tax positions, and then running scenarios across a 15 to 20-year horizon. That is not a tax return. That is a tax strategy. And it requires a different kind of professional, a different kind of conversation, and a different kind of fee. Most Australians never pay for that conversation because they don't know it exists. They assume their accountant, who has always done right by them, is seeing the whole picture. The whole picture costs extra, and nobody sends you a letter telling you that. The ATO publishes every rule that governs these strategies. The legislation is public. The ATO guidance notes are online. None of it is hidden. What is hidden? Hidden not by malice, but by the gap between compliance accounting and strategic planning, is the conversation that connects those rules to your specific numbers and your specific family and your specific window of time to act. Neville found that conversation 18 months before he died. David got $310,000 that would otherwise have gone to the tax office. Sandra has not had that conversation yet. Neither probably have you. The window for each of these strategies is different, and I want to be precise about this because the timing is everything. Debt recycling works best started in your 50s with at least 10 years of working life ahead. The compounding effect of converting dead debt to productive investment debt needs time to build. Started at 65 with 2 years until retirement, the benefit is limited. Started at 52 with 13 years of cash flow available. The restructured portfolio at retirement is materially different from the unstructured one. The super recontribution strategy works between age 60 and 75. The earlier in that window you begin, the more cycles you can complete and the more taxable component you convert to tax-free. Someone starting at 62 has 13 potential years. Someone starting at 72 has 3. 3 cycles at $110,000 per cycle is $330,000 converted. Meaningful, but not complete on a large balance. 13 cycles changes the picture entirely. The testamentary trust can be set up at any age because it comes into existence at death, not before. But the will needs to be drafted correctly and the estate needs to be structured to flow into the trust cleanly. A will written in 2008 that doesn't include testamentary trust provisions needs to be updated now, not when you are ill. Now, an updated will with a testamentary trust structure costs approximately $2,000 to $5,000 through a specialist estate planning solicitor. Against a potential tax saving of $100,000 to $200,000, the return on that cost is not complicated arithmetic. Here is what you do this week. First, calculate the embedded capital gain in every investment property you own. Purchase price minus current market value. Apply the 50% CGT discount. Estimate the tax on that number at your beneficiary's marginal rates. Write that number down. That is your CGT exposure at death under your current structure. Second, contact your superannuation fund and ask for a split of your balance between taxable and tax-free components. Most funds will provide this in writing. If your taxable component is above $200,000, ask a specialist whether the recontribution strategy is available and appropriate for your age and balance. Third, pull out your current will. Check whether it includes a testamentary trust. If it doesn't, and most wills written before 2015 don't, book an appointment with an estate planning solicitor this month, not your general lawyer, an estate planning specialist. Fourth, if you have both a home mortgage and investment debt, purchase price minus current market value. Apply the 50% CGT discount. Estimate the tax on that number at your beneficiary's marginal rates. Write that number down. That is your CGT exposure at death under your current structure. Second, contact your superannuation fund and ask for a split of your balance between taxable and tax-free components. Most funds will provide this in writing. If your taxable component is above $200,000, ask a specialist whether the recontribution strategy is available and appropriate for your age and balance. Third, pull out your current will. Check whether it includes a testamentary trust. If it doesn't, and most wills written before 2015 15 don't. Book an appointment with an estate planning solicitor this month. Not your general lawyer, an estate planning specialist. Fourth, if you have both a home mortgage and investment debt, debt is not the enemy. Tax is not inevitable. The structure of your assets in the final years of your life determines how much of what you built your family actually keeps, and how much disappears into a calculation that was locked in before anyone had the chance to change it. He had the conversation. He found the specialist. He rearranged 3 things, and his son David received $310,000 more than he would have received if Neville had done what most people do, kept the same accountant, filed the same return, and trusted that everything would work out. Sandra is 61. She still has time. The window for all 3 strategies is open. Right now, today, there is someone exactly like Sandra who is going to have a conversation with an estate planning specialist this month. They are going to hear a number, the invisible tax sitting inside their current financial structure, and they are going to rearrange 3 things. In 20 years, their children will get that money. And there is someone else exactly like Sandra who will not have that conversation, who will keep the same accountant, file the same return, and trust that everything will work out. In 20 years, the ATO will get that money instead. The rules are the same for both of them. The outcome is different. The only variable is whether the conversation happened. You just had it. Share this with someone you know who is over 50 and has never heard the words testamentary trust, recontribution strategy, or debt recycling in the same sentence. One conversation. Tonight. This is Mitchell Levi. Before leaving, if you are a Cleaver Australian, transfer these 3 assets before aged care, or Centrelink clause, back your entire super. Watch this now.